But what about the value, or you know purchasing power of your deposit? So what about that? So that is also very important. Because next year, will you be able to pay, and will you be able to buy more goods? Will your purchasing power increase? Now that is the very important thing. Okay, now is the money worth? That is the most important thing. So let me write down here: is the money worth rupees 110000 is sufficient enough to buy the same basket of goods that you were purchasing last year? Can you be able to buy the same goods? That is my question. So like that means, will rupees 1,10,000 be the same amount of goods, less amount of goods, or more amount of goods you will be able to pay? Now that all depends on inflation. Yes, so that all depends on inflation, whether you will be able to buy more or less in the economy. So generally the trend is that inflation always increases, there is no decrease much. So you will always be able to buy less with the amount, because last year whatever you were buying, you will not be able to buy the same products. Okay, so now let me just give you more examples so you will understand this better. So let's say, let's say the inflation rate in the economy during the period is 20%. Okay, so what will be the value of your deposit at 20% inflation rate? Okay, so that is the real value. Okay, so now let me just write it down so that you understand this better, because the real value is basically, if it is 20%, you have to see how the calculation is done. Okay, so this is called as the real value. So the real value in terms of goods that can be produced, or rather, let me not write produce, I'll write purchased, from rupees 1,10,000 is actually much less. Yes, it is much less than what it used to be a year ago. Okay, so now the part, the, like say for example, the basket of goods which was 1 lakh last year, remember the inflation rate, so inflation rate is 20%. Okay, is now costing 1,20,000. Okay, and the bank has paid you how much? Bank has paid 1,10,000. Okay, so the interest rate has beaten the bank rate. Okay, so the interest rate of the bank has failed to beat the inflation in the economy. Okay, so this is the point. So now I think you're understanding what is the real interest. Okay, so let me just rub this. So the interest rate of the bank has failed to beat the inflation in the economy. Therefore, the real interest adjusted after inflation that the banks have paid you on your deposit is actually negative. Yes, is actually negative. In fact, you went into a loss. Okay, negative. And what is the deficit? 10%. Okay, so now let me give you the calculation and what is an inflation rate. You will understand this better. So rate or real interest rate. So what is the equation? Okay, or what is the formula? So real interest rate is equal to nominal interest rate minus inflation rate. So what is the inflation rate? Is 20. So 10 minus 20. So that means minus 10 is your real interest rate. So you're actually going back, you're not going front. So that is the very, very bad news for you people. And that is why I'm saying is, that is what is the cost of inflation, which is very, very, difficult. Because as I said, that is what we have to know, what exactly is the real interest rate and what is the nominal interest rate. And you can only understand this by way of, if you understand like the cost of inflation, and the real interest rate is always much higher than the nominal interest rate. In this case, if you see, we are going is negative. Yes, okay. So now we will go with the next one, that is the cost of inflation. So let me just rub this. Okay. So yes, the next topic is cost of inflation. Okay. The inflation is considered to be bad for an economy mainly. So inflation is always very bad. Why? Mainly because it destroys the purchasing power of money. So when price rise, okay, each rupee that you will have, okay, or that you had, will buy you less quantity of goods and services. So basically inflation is considered to be bad for an economy because, as I said, it destroys the purchasing power, and whenever the price rises, each rupee through which with each rupee you will buy much less quantity of goods and services. Okay, Now, the argument is particularly true for a country like India, where which has an informal sector, especially in agriculture sector. So, since most of the population is concentrating on agriculture, and where the minimum wage is also very very less, and there is no social benefit, no social security, so there is no medical insurance, so there is no provident fund and all. So, people in these sectors, they are very much badly affected in inflation. Okay, and they are mostly affected due to inflation. So especially in India, where it is mostly people are dominated, or mostly people work in the agriculture sector, where there is no social security, so they are very badly affected because they do not have a very high purchasing power. Okay, so now that's when the price rise. So let me just write down here so that you understand this better. So in especially in India, inflation is very very bad, and it has to be well controlled. Okay, so the wages in the agriculture sector or other sectors are not for inflation, because if inflation hits India, it's very very bad for them, so there is no protection for them. In other words, I can write no protection from inflation. Okay, so thus when the price rises, their wage does not rise, and they lose due to a reduction in real income. And on the other hand, first of all, real income is low, and moreover the wages are also not increasing. So wages are not increasing and prices are rising, so how are they going to sustain in this? Okay, so on the other hand, no rise in wages too. Okay, so that is why they are associated, as I said also, that cost of inflation, as I said today, in India inflation is very very bad. As I said, it will very badly affect because it affects the purchasing power. So there is also two things more associated with the cost of inflation. Okay, so let me write down here. So there is also two associated social cost of inflation. Okay, so there is some more things also where the social cost of inflation is affected. So the first one is called as, let me write down here, the shoe leather cost. Okay, so let me give an example here. Suppose I take an economy. So suppose in an economy, the inflation is rising at the rate of 5% from the past few years, from the past few years. Now in such cases, what happen, people will in the future also, so in such cases the people will expect, okay, to be 5%. What to be 5%? The inflation to be 5% in the near future. But my question is it true? If it's last year 5%, is it necessary that this year also is going to be 5%? Okay, So let me continue this point. So in such a case, all the economic transactions will be done adjusting for 5% inflation. So if next year if I'm doing some trading, I will just see that at least I will increase that to 5%, and I will adjust, because I know maximum 5% there will be increase. So I will adjust on my economic transactions to 5%. Okay, because I will anticipate that this is also going to be because if I have a next year loss, so that I don't have loss, so I will increase 5% so that I will know that I should not have any loss. Okay, so in such an anticipated, so what is anticipated? I'm expecting. Okay, anticipated inflation scenario, the only cost of inflation will be the shoe leather cost. So what is shoe leather cost? So let me just write about this, the shoe leather cost. Okay, so what is shoe leather cost? Let me just okay, so we wrap this and let me explain you more of shoe leather cost. So when does the shoe leather occur? So we have to know this very well. So let me write down here. The shoe leather cost occurs because of the cost associated with holding money during inflation. Okay, so when you're holding money during inflation, the shoe leather cost is occurred. Okay, so now since, as I told you, inflation destroys, what does it destroy? So since inflation destroys the real power of money and cash holding does not pay any interest, so what they will do, because if you keep the money in your hand, nothing will happen. They will not pay any cash holding will not pay any interest, so obviously the people will keep the money in the banks. So the people will start depositing their money in banks to earn interest rate. Okay, so now we are coming very closer. So the less money they hold, in cash, the more they have to visit banks or ATMs to withdraw money. So the money, if they have less in their hands, so they have to occasionally go to the bank or or to the ATMs to withdraw money. Now, since going to the bank is not free of cost, both in terms of time, so both in terms of time and the transaction cost, okay, levied by the banks, on, or ATM usage also, 4 or more minimum withdrawals, they will charge you money. So on ATM usage, or counter withdrawals, so you go to the counter and you withdraw. Okay, so counter withdrawals, okay, as well as traveling cost. So let me write down your traveling cost to banks will add to shoe leather cost. So I understood. So shoe leather cost is the ones which you are extra cost which you are bearing, that is also going to add you to the shoe leather cost. So I told you the less money it occurs when the cost associated with holding money during inflation. So when you're holding the money, where you're keeping the money, and how many times you're withdrawing the money, so that all is accumulated with the shoe leather cost. The next, as I said, there are two associated social cost of inflation. So the first one was shoe leather cost. Now we will go with the next one, that is menu cost. Okay, so let me rub this. So yes, menu cost. So menu cost is another social associated with anticipated inflation. Now the menu cost is derived from the name of the restaurants, especially from the restaurants. Okay, restaurant business, generally this is more applicable. So the name menu cost is derived from the restaurant's business, and menu cost arises because inflation makes the business change, okay, and requires the firm or the business company, the firm, to bear expenses. Okay, now what kind of expenses? They are related to printing cost and also related to printing of new catalog. See, because every year the price is also changing, so the catalog is also changing, so there is that printing cost. Who's going to bear that? Okay, or new printing cost, or new, I can mention your new price list, etc. Okay, Moreover, what are the other things they have to bear? Let me just write it down here. So they also have to incur expenditure on advertisement to inform customers about their prices. Okay, so this is also very, very important. Okay, so now let us see the effects of inflation on different sectors.